From one retail investor to another, this is Trader72. Welcome back to my show, guys. I hope you are all well on this fine beginning of week. It's another hot one in the UK, but we're ready for it and we're ready for another week. Now, sounds like straight out of a sci-fi movie. A software company called after a magical crystal ball in the Lord of the Rings. Yes, indeed. I am not joking. This is what the name was named on. And this is what we're looking for today. We're analysing Palantir. It has had a very interesting background. I must admit, probably one of the fun ones I've had to look at in terms of how it started. So we're going to break it down past the company hype and market pressure of the share price, and delve even into Palantir in detail. So from what it does, its history, what it does, numbers, and bears versus bulls case, and etc. And also the most important part, is the share price overvalued or not? This is what we're going to discover today through my usual DCF model, which we obviously like to go through in terms of free cash flow, and then a final thought from me. So without further ado, let's looking here at the Palantir, obviously AI-powered automation for everyday decision. It has recently, obviously, was a cyber security company, as you can see there, but it has also now moved into something called API, which is the corporate market going forward, which I think is possibly could be a very interesting avenue to increase the revenue and the numbers for Palantir going forward. So let's look and break down, just going through the website as we see now, Palantir in more details. So the history of Palantir, guys, let's start with that first, because it's always interesting to kind of get the meat and bone of a company, the background, the history of how it started, how it was spawned, and then we'll go into what does actually the business do, what kind of, what do they have under that roof, what do they have under that umbrella of Palantir, and I think some of you may find it quite interesting in terms of what they do now going forward. Some of you may already be aware of it, so apologies if I'm going to bore you with all the details, but we will come also to the juicier bit about the numbers and if Palantir makes sense in terms of revenue, profit, etc., as we know. So start from scratch, which I thought was amazing. Palantir was founded in 2003 on the back of post 9/11 by two billionaires called Peter Thiel and Alex Karp. Alex Karp we know probably most of, quite eccentric character, but really finger on the pulse in terms of going forward for Palantir. So it's certainly one of the main drivers. So following the attack on 11, they built Palantir to fix the intelligence community's data problems. So loads of various different data, all jumbled up into these data centers, and of course somebody needed to kind of sort out that data in the right spot. So early funding came from Peter Thiel and the CIA's venture capital arm in QTEL. So it has got a CIA background, which I find is a bit like a spy movie. This is hence why I opened my intro on this sci-fi / spooks movie a little bit. And it has kind of shades of this really in terms of how it started. Then Stage 2 became a government secret weapon from 2005 to 2010s. For years, Palantir operated in near total secrecy. Again, like a film there, they were exclusive for agencies like the CIA, FBI, and the defense. You couldn't make this up. They gained legendary reputation from stopping threats, cyber attacks, and massive fraud rings. So that was primarily what they were brought in or started to do. And then they pivoted into big business, into corporate business, realizing that the corporate businesses had the same situation or same issues with data problems than the defense companies or CIA and FBI. So why not launch a foundry to conquer the corporate world? So that helps giants save billions of optimizing factories, energy grids, hospital staffing, etc. So again, plugging in their specific AI, plugging into various different companies, but tailor-made to those companies. And then it went public whilst the AI boom started back in the early 20s. In September 2020, Palantir hit the public stock as the ticker PLTR. Launched the AIP, sparked massive growth. Now, AIP, I'll come to that in a minute, because that is, as you'll see above there, something that the market really likes, and I think the way Palantir have moved into that area is very, very clever. So they now run a boot camps where businesses build working AI systems in just days. Yes, just days. Amazing. The world is moving so fast. So that is how a brief history of Palantir and how it moved to where it is today. Now, breaking Palantir into three parts. Palantir Gotham, as you can see, so three core products, the platforms. Palantir Foundry and Palantir AIP. Now, Palantir Gotham is built for the military, defense, and intelligence agencies. It helps maps out terrain, tracks threats, and plan mission amazingly. So any kind of battle scene coming up or any terrain they're not sure about, Palantir will actually, with its data and its AI, sort out basically the terrain and the weather forecast and whatever else is in the way of that specific battle plan. So amazing, really kind of amazing in that side of it. And Palantir Foundry, which is built for big businesses, it helps companies like Airbus build planes faster or racing teams optimize their pit stops. So I'm a big fan of Formula One. Again, never realized that Palantir were involved in optimizing pit stops and increasing the pit stops or decreasing the time on the pit stops, which again is something that wasn't well. So Palantir AIP. Now this is the clever bit here. It connects a company's private data to secure AI agents to employees can ask questions in plain English and get instant answers. So something like, where is our supply chain broken right now and how do we fix this? This is obviously coming from an MD or a CEO, and it analyzes all these issues and will tell you within split seconds the information that you need about, let's say, a ship. If you're in a shipment business, one of your boats has disappeared or is not working, or there's been an issue throughout the chain. Instead of the CEO having to call through 10,000 layers of management, it can literally ask basically an AI assistant to actually analyze what the problems are and how to fix them. So that is the future potentially of what we're looking at. Again, amazing system, and this AIP has certainly, as you will see as we go on, been a big success for Palantir. So basically, Palantir, what are they? They're ultimately a digital translator turning chaos into clarity. Palantir is the ultimate digital translator and brain. They clean up, map it out, and use AI to help humans make critical decisions in real time. So imagine a massive global company. Every day they can generate mountains of data such as GPS, employee shifts, financial spreadsheets, literally can sort out diaries, and as I said, financial spreadsheets and balance sheets, P&Ls, and can help with supply chain inventory. Most companies are drowning in this data because it's trapped in different messy systems that don't talk to each other. So basically it makes the systems talk to each other variously. It can also be plugged into various hierarchy within the company without actually overlapping on others. So again, amazing. So that is what Palantir do in a very simple way. Trader 72 is all about simplifying the search for you guys, and that's, I don't think there needs to be, we live in a world where everything is so overly complicated, and I don't think we need to overcomplicate a search. Like, we don't need to overcomplicate football as it is. That's my opinion. So this is why I like to break down my research. Obviously not as simplified as this, but just to give you a really black and white idea of what Palantir do in its history. So that's covered for now. Let's move on to the next step. So let's break down Palantir's revenue and debt breakdown. Now, there's hardly any debt, let's be honest. But I do like to have a look at how the revenue is broken down and what makes money for that company as a kind of a pie, as you can see there. This is the most clarified way to do it. So clearly there's two major incomes there for Palantir. There's the US government contracts, which are regular contracts with Uncle Sam, as it says there. It's currently up 84% year on year, and it's 54.9% of the revenue in total. So that is more than half of its revenue. So still fairly reliant on government contracts as it was started. US commercial, so obviously that's up massively, 133% on the year, so literally smashing it really at the moment at 595 million. So it's obviously corporate America, it's adopting AIP at a record pace. Again, this AIP we talked about in terms of corporate side and plugging in the AI bots in that is absolutely crucial to their business, and surely now going to be one of their main earners, but it's still just under 50% of the income. So we're looking at the total debt. There's practically no debt. 212 million is extremely low for a company of its size, mostly office leases and minor obligation. It has $8 billion in cash and short-term investments, so sitting on a massive mounting of cash, which obviously we like as an investor. And most important, the adjusted free cash flow here, just under 1 billion, generating an adjusted free cash flow in the first quarter of 26. So these are basically just quarters. We will get an overall idea of the trailing numbers overall for the past 12 months in shortly. So the balance sheet of basically Palantir extremely strong as its moment. The takeaway is Palantir is in a rare position in the tech world. They aren't burning cash to survive. They're highly profitable, growing revenue at 85% year on year with an $8 billion cash pile. So I think it's safe to assume that so far, to start off with the numbers, it's a pretty impressive revenue, and the fact that it's up year on year is a big plus again for the future, especially for value investors going forward. So I like to break down the 4Ms, which obviously is a system I learned from Paul Town, Rule 1. You should definitely read the book. And it's basically broken into 4 different parts. Now, margin of safety, I'm going to take that out for now because we're going to keep that for the towards the later part here in terms of margin of safety based on the intrinsic price, which we haven't worked out. So we're not going to check that in yet. But the top 3 here are all a check. So meaning, obviously, we understand what the meaning is. Operating systems brain. They charge companies a subscription fee, which we like because subscription fees also mean that it's regular income, a bit like an Adobe, although Adobe not doing as well now, but obviously that's different businesses. But a subscription-based business is always good, guys, because it basically smooths out the revenue across the year. And like I said, guaranteed earnings. Palantir has one of the widest moats in tech. Once the military government, once the military government or a massive organization plugs their data into Palantir's ontology, it becomes almost impossible to switch. High switching costs, which obviously we like, and plus top secret security clearances. So we know that they have a huge amount of moat within the US military service, military system, cyber attack, cyber defense, which obviously is second to none in terms of value. There's other companies obviously that are in that market, but Palantir has a huge moat in that market. Now the AIP side, or the corporate side, I think it's still settling in. It's obviously catching up a little bit. It's a new side of the business, so maybe not quite as much as a stronghold in moat, but the moat is very important. It's an established company within a market. The more dominant, the better it is for value investors or any investor, even if it's a more middle term side of an investor. So it is important to know that that company has a major foothold in their market, hence the moat being important. Massive check so far on that end, meaning management obviously run by 2 guys, Alex Karp and Peter Thiel. Massive skin in the game. They own a huge amount of stock, which is always a good commitment by any management. Any management that buys lots of shares internally means that they believe in the company. They also believe in the company going forward. Now, obviously, it is at sky high limits at the moment, so there's a good chance that there's always a plausibility that they may sell some of their stock. But what would be interesting is if the stock does fall through, will they buy more? And do they believe in their business? That's always an important part. But so far, they've also had their foot on the pedal in terms of moving forward with an extremely good visionary forward-thinking strategy by both of these guys. So we can't fault management, and it's also a check. So, you know, a little bit eccentric maybe. Might be the twist there that we're talking about. So far, all the 3 out of the 4 are checked. Now, will the margin of safety be the 4th completed check? You normally tend to want that to happen if you're going to move forward with the investment. So let's now move to the key financials of Palantir. Overall numbers, 2026, obviously it's all quite organic. The numbers move quite quickly, but this is what we have as a trailing numbers at this moment in time. So the first thing I like to look for is clearly the market cap, which is what the company is worth. What would you buy it for tomorrow? It's off of $280 billion at the moment. No small prize there, no small change for sure. Now, the next thing I like to look is at enterprise value, which you guys I've broken this through before. If you want to know a bit more, go back to some of the videos in terms of how I break through. Enterprise value is obviously the difference between that and the market cap is obviously the debt, and it is obviously clearly no debt. We've just seen that that there's a minimal amount of debt, but more based on leases and buildings than actual leverage debt. So at the moment, it looks pretty clear. Now, on top of that, which is even better news, is the free cash flow, which I abide to at all costs, because the free cash flow, unlike net income, which a lot of people look at, is obviously slightly fidgeted by the accountants, and free cash flow is everything gone, done and paid for through operations and costs, and that's what's left at the end of the day. And that's the free cash flow, is the cash that the company will be reinvesting in by doing buybacks, paying dividends, and buying obviously acquisitions as well. So that is the all important number here. It's gone from 620 million to 2.68 billion dollars in a space of 5 years. So I like to have a look at 5-10 year difference, so it gives you an idea of where the company has gone and what direction the numbers are going to. Now, in terms of, let's keep with the good news for now. The gross margin is at 82%, which is an amazing margin. That means for every dollar they make 82 cents on the dollar. So, at a rough estimate, a rough idea. So amazing gross margin. Revenue growth, you can see, has gone up by about 2 to 3% in the last 5 years. So not a huge amount, but enough there to compound. Profit margin is at 53%. So over half the company's profit is a credible number there. Now, and also total acquisition, a little bit higher than, last 3 years, nearly 3 million, 2.93 million, which is minimal in terms of that. The return on invested capital, which is what the money they reinvest when they have the money, or the profit, is 30.98%, which is way above my criteria of 10%. So very impressive there. Again, a big tick on that. Now, where we might have a few issues is the price to free cash flow, which, normally you'd like to have it under 30, and it's currently at 104. Now, if some of you, so we're not losing too much time, who may not know what price free cash flow, it's in my last video for Broadcon. It does explain what that means. But for now, as a criteria again, anything under 30 means that the share price is, it's not quite as expensive in terms of free cash flow. And at the moment, the free cash flow at 104 is quite high. That's a concern. It was actually at 515 before. Now, we could add the fact that, of course, it's a tech company on the up. It's made a tremendous amount of money very quickly, and therefore the numbers do get slightly distorted to a company that's already established on the markets. The other issue for me is the P ratio trailing at 141 times earning, with a forward earnings, by the way, of 77, which is not on that graphics. So it's still very expensive in terms of P ratio. And the P ratio is one of the main flags or main flagships of if the share price is at, if the company is expensive or not. For me, 141 is quite high, even for a tech company. So that to be combined with the DCF, we can maybe have another look, and that we'll see if that kind of affects my final decision by the end of this. But for me, that is a little bit of a red flag, both on the P ratio and the price to free cash flow. Please do check yourselves a little bit more detail if you need to, of course, but certainly something to look for. But all in all, fantastic numbers. Revenues up, free cash flows up, net income is at a profitable, fantastic, net zero debt. So for now, from that point of view, explosive AI platform driving growth. That's the big takeaway from this. But like I said, a few red flags there to bear in mind. So as we know, bull versus bear case. I like to have a balance of both. I think it's really important to have that when you're looking to invest in a company. There's always a good and bad in every single company you invest. Even the best company in the world, Nvidia or Microsoft, have a bear versus bull case. So I think this is good to have a balance of the two, and make your mind up if there's any issues, especially on the bear side, or if you think that maybe the bull side is slightly overdone, something to look into further if you have any doubts. So the overall picture of this is, again, brief statements on both sides. This is up to date pretty much. So Palantir numbers are blowing up, as we've seen, 85% year on year. And a draw dropping 133 on the API side. They've also got NVIDIA partnership validation, announced a major strategic initiative with NVIDIA to optimize and deploy NVIDIA's AI models inside Secure. That's Palantir's essential plumbing to make AI model usable and safe. So that is a big plus for sure, especially with Nvidia being the darlings of the AI side. Now, elite club of profitability. Now, CEO Alex Carr pointed out that Palantir's Rule of 40 score hit an unprecedented 145. Now, to explain to you guys what that means, because I had to look it up myself in that respect. Though the Rule of 40 is a popular financial health check using by investors to evaluate software and technology companies. It is the state of a healthy software company's growth rate combined with its profit margin should equal or exceed 40%. So I think that's the biggest takeaway there, that sentence there. So once you get that, then when he means by 40, basically the growth rate combined by profit margin, if you're looking at currently the driven by the number, what Palantir have come up with is 145. So clearly crush that 40. Now that is down to, of course, the demand for artificial intelligence platform AIP, which I think has massively helped. And of course, the year-on-year revenue up and adjusted operating margins up as well. So a score 40 is considered to be the gold standard for any elite software. And of course, they've gone way past that. So that's just to explain to you guys what that meant. So I hope that clears it up. And sticky defense of contract, they continue to lock down massive multi-year states backlogs, including a legendary $10 billion US Army agreement and a new $300 million USDA deal managing global supply chain risks. So, all good on the bull side. Palantir is no longer a speculative AI, I think, bet. I think that's probably right. And it has a enterprise infrastructure. The recent stock pullback is just a massive buying opportunity. That's what the bull's case is. Now, on the other side of that, the bear. Severe multiple compression. So even after dropping significantly from its 207 peak, the stock is still trading at a trailing P of roughly 141. I've already flagged this up, so we don't need to go too much into that. The forward P ratio is at 77 as well. So as it stands now, there is no chance of any mistakes from them in terms of their future trading update because it's still at a peak premium. Now, big AI labs, OpenAI, Anthropic, and Google are building their own enterprise workflow software. Why will company pay Palantir a premium as the middleman when they can deploy an AI agent directly through cloud providers? Now, that's another very valuable point. If those big boys decide to go into that, then that could put Palantir in a slight pickle in terms of their bottom line, especially if they decide to go directly to Anthropic or Google, OpenAI, I mean, even. So that could be something to look into further, guys. I would strongly advise that. So I think that the first 2 points are already pretty good points from the bear case. Consulting heavily scalability, deploying Palantir's ontology and AIP still relies heavily on forward deployed engineer. Maybe less of a case on that one. And finally, least but not last, geopolitical and churn risk. Now, that is always a big danger with dealing with government contracts or governments of every different country due to changes, scrutiny from the public. There's been recent friction with the UK over the NHS data platform contract, highlights the constant political risk in their government revenue slice. And also change of government, maybe change of budgets. They are the behest of that change. So that also is something that you guys may want to be aware of. At the moment, on the, pretty much Trump expanding on the defense side, I don't think they have a problem. But a change of political scene in the next couple of years, as we know, for the next election could change. And any other government they deal with in terms of crisis. So it's something that they are a little bit exposed to, which could be a problem. So Palantir is an excellent business, but paying 115 free cash flow in a market where the broader AI trade is cooling down is incredibly dangerous. The stock has a long way to fall before valuation matches reality. So again, good points on both, as per usual. And it's up to you guys to whether you think there is some good cases on that side and some further investigation to be made by you guys. I would strongly advise to do so. I think there's some good cases on both sides which already exist with Palantir as we stand, but the future with the bear case is something that you should definitely be aware of, especially if you're looking at 6 months to a year holding or further that as a value investor. Now, here comes the DCF model, which obviously gives you the true worth of the share price. Now, as you guys know, and I've said this before, any share price based on the market can be overvalued or at a premium. And what this gives you is the true worth price minus the margin of safety, which gives you a buffer in case the share price does fall back when you invest. And they, as I said, MOS is a margin of safety. It says what it says on the tin, pretty much. And it's important to work this out. It's like when you buy a house, you want to know the exact price of the house, not what the market offers you. It's all about the brick and mortar. And in the share price world, it's a similar situation in terms of now we've locked in what the company is about, what it looks for, what's the skill set of it, what the numbers behind it. We now want to know that we're paying a great company for the right price. That's also very important, because a good company at the wrong price can be a nightmare in terms of losses going forward. So locking this now, intrinsic price is about an idea of what the overall future earnings will be, the growth rates. Now that can be slightly speculative in terms of if whether or not you want to go low, conservative, or quite aggressive based on what the last company, the history of the company in terms of growth. Now, I tend to go on the history, and as you will see, I've gone for a 25% growth rate. That is a middle ground here of the choice, which obviously gives me $134 intrinsic price. Now, if you wanted to feel that after making 80 to 63% the last 3 to 5 years, you think that that's a bit low and 30% might be a bit more aggressive, then obviously that will come at 178, which obviously gives you a higher margin of safety for going forward once you've knocked off or minus the safety margin of it. Or you could go and think, well, it's going to reach a plateau at some stage. There may be some future issues, and you think that maybe a little bit relatively pulling it back to 20% might be a better idea. Now, that's entirely up to you. My guess is at the moment, based on the numbers going forward, is that I think 25% growth is in about the middle ballpark. So that does give me 134. Now, the reverse DCF, which is what the market is factoring in terms of growth as we stand, is 24%. So that only gives us really a 1% growth, which is minimal based on the intrinsic price and what the company's worth, or what the margin of safety. Now, you could go from 24 to 30%, which gives you a bit more margin there, as we understand. Now, discount rate is obviously 8%, which is going forward. Money grows, obviously, but not devalues, but overvalues, obviously, so that you have to give it a discount. And the perpetual rate beyond the 10 years will be 3%, which is normal GDP average, as we know, because you can't give it an 8% beyond 10 years forever. We don't know where the company, at what stage the company will be, of course. So that gives you an overall, what you call a terminal rate or perpetual rate. Now, 134 gives you effectively, based on the current share price, which I think is around 126. I need to double check. It gives you a very minimal margin of safety of 5.4%. Now, some of you may say, well, at least it's undervalued. Might be worth a punt. Great. It doesn't give you a massive margin, because really, to make it worth your while in terms of less towards the premium side, is to get it around a minimum of 20 to 25% to give you a bit of a buffer. Now, entirely up to you guys what you want to do. Please leave comments below if you think that you are happy with the margin of safety around the 5 to 10%. For me, 25% is probably a bigger margin. Some investors might even like further than that. Some value investors look at 40 to 50%. So entirely up to your side. Wall Street, by the way, does forecast the share price. This is not the intrinsic price, the forecast, the target of $184, which gives you a 45% upside. So if you were to buy the company on the dip and maybe wait a bit longer for that to drop, then that might be something to look at going forward. But that's entirely up to you guys. I'm not here to give you, I'm only here as an advisory based on my experience and this DCF model, which again is open to discussion in terms of what the growth rate is. But I think for me, 25% is about right, and the 5.4 currently is well short of my criteria. So my final thoughts, guys, into Palantir. Now, it's been a very interesting research, I must admit. A fantastic company. There's no doubt about it that from a shadowy government contractor to a standard software layer of AI, it has, leaps and bounds in terms of striding towards an amazing company. There's no doubt about it that the AIP, moving forward into the AIP in the corporate world and plugging the AI systems, into the corporate world is genius as far as I'm concerned, and it certainly has helped their numbers because they were going to be static. The cyber security business is a great business, but they need to move it on from there. So I think with the revenue exploding 85% year on year, free cash flow, we've already gone through all this. ROIC being at 31%, elite level as it says there, and cash versus balance sheet of $8 billion. There's no doubt about it that it is a company with great, solid, rock and roll numbers here. Now, there is obviously a but to this, and my but is obviously buying a truly great company at the wrong price is still a bad investment, guys. And I know this sounds a bit cliche, this has been said by many different investors, but it is nothing more true than I have done this myself, buying into a great company that I think is amazing, but buying at the wrong price can be absolutely deadly for your cash in your account value or your percentage of your account. So this is where I think the issues are. The trailing PE ratio at 145, too high. The fact that the price to free cash flow at 115, way too high. It already has had quite a few big drops. We know that, but we're still, I think, paying a massive premium on that share price, even currently at the 129. I think it's a bit 126. We'll double check with the stock price, the share price in a minute. So I think the share price did get already tired of the massive premium. It has cooled off a bit. I think the bottom line on all this really for me is that it's basically on the watch list. I know I've been saying that quite a bit recently, but a lot of these companies are overvalued and it's not worth the risk at this moment. Even so, I think it's a fantastic company. If I could have bought this at $24 a share when it was about 2 years ago, I would have definitely still be there and made lots of money. Unfortunately, we are reaching at the top end at the moment of the share price. I still think that based on the DCF model and a very lowly margin of safety, it's not worth the risk. Now, I will come to where I think the entry point might be better, even if it maybe went towards more 20%. Most of these companies will never go down to anywhere near 50% margin of safety, but at this moment in time, 5% is way too short. It has Palantir is the stock that's trading entirely on a promise. And I think from a long-term bull way, use a micro pullback to dollar cost average into a generational winner potentially. So maybe wait for a pullback, and then after that, keep putting money into it on a regular basis, maybe through an ETF as well. That might be another option. And if you're a value investor, keep the Titan on your watch list, acknowledge this incredible fundamentals, and wait for the broader market flush to buy it with real margin of safety, which I've just said. So that says it all. So for me, that's my final thoughts. Watch list, wait for the right price maybe to take a pullback. Just to finish this off, I do believe the reason why I'm saying as well, be careful when you're buying at premium, is once the trading updates, because we are coming to earnings season, and if their numbers don't come up to scratch, especially with the forward guidance, which is the ultimate guidance we're looking for, I'm sure they'll come up with great numbers for this the last quarter. But the forward guidance, if they fail in any remotely off what the market expects, you could be seeing a major pullback, and that's when you could get caught out as a retail investor. So entirely up to you guys. Let me know what you think on the comments below, if I'm right or wrong. I'm always happy to be told I'm wrong, or people, within reasons, obviously, in terms of understanding why potentially you think this is the right time to move in, or whether you completely disagree with my model in terms of DCF and the margin of safety. I'm all ears for you guys to let me know, obviously. Like I said, tremendous company, just not the right price at this moment in time. And that is my final thoughts, guys. Let's move on to the news and where I'm with my portfolio. But like I said, leave some comments below and let me know what you think. Now, just to finish this off in terms of the actual share price and the chart or technical analysis on Palantir. Brief one here, 1 week chart. Currently at 130, it's moved up a bit this afternoon, the afternoon session, obviously. But it is currently under the 50-day moving average, as you can see the purple line here, and well above the big one, which is the 200-day moving average. Anything below that means obviously a potential retracement. It is on obviously it was at its high of 220, so nearly $100 more back in November of last year. It has had a higher high and a slightly higher low, obviously down that way here. Now, if there was to fall back to, I would have thought, around the 200 moving average, you're looking at 85 to 86. That would be potentially a buying opportunity from, I think, a bull value investor. Even though we'll have to work out what the margin of safety is based on that. But I would have thought that it'll be more towards the 15-20% mark, which then would be more attractive for me to potentially move in. And even if I did move in, it would be, as I always do, in small increments to start off with, maybe 20-25%, and then if it fell back, buy more. So that's obviously a bigger something that I would always do going forward now, instead of buying in at 100% of your cash. I mean, if you're looking at the difference between, a couple of years ago, $24 a share, and now to a phenomenal 230, it shows you the mad world we live in terms of AI at the moment, or anybody connected to AI or defense, cyber security. But it has had a phenomenal move. But it has had some, it is quite erratic and moves after 19 back to 93. But it's certainly in slightly more decline in the past since 2026, really. The high low of maybe 195. So for me, long-term wise, probably around 85 mark on my watch list, 85 to 90. If you are a short-term investor or a daytime investor, obviously there's great opportunities to potentially buy on the lower, maybe around the 115, 120 mark. Again, I'm not an expert completely. This is just me advising. Some of you may have a better idea of that. I'm talking absolute rubbish. But I would suggest that if you are a short-term buyer, even if it's a month or something like that, maybe, or depending on your time schedule of what your strategy is, I think about 115 to 120 is probably a good pullback there to buy back in on the bounce. Be careful of the falling knife when it's that high, meaning obviously you buy and it falls, and you buy and it falls, and it buy, like I did with Adobe, which I've learned the hard way last time around. So that's Palantir, guys, in terms of where I feel my watch list and my, the number that I would potentially look at would be definitely under 100 at this stage, and even maybe lower if I was to buy around the 25% margin of safety. But now going forward in terms of news now, guys, briefly, quickly, because I don't want to bore you to death. Sometimes I'm maybe a little bit too long on the show here. So Wall Street future rises following a solid weekly last week. Obviously the non-payroll funds came in lower than expected, which means no potential hike as expected. So the market liked that. It was fairly buoyant before obviously Friday, the Independence Day, where obviously the US markets were shut down. So that went down quite well with the market at that time. Future other news. Obviously it is earning seasons, guys. We like earning seasons, especially for short-term buyers or daytime traders or monthly traders or value investors who want to buy a bargain on the back end of trading update. But it is about to start this week with Pepsi Cola and Delta Airlines. It will be interesting to see where obviously retail and people's money are being spent already with those two companies. That will give us an idea of where the economy is. So be aware of that. And of course, that will then kick off into a huge deluge of numbers up and coming for all of us in terms of whoever we're holding or maybe looking at buying. So now quickly at the markets, we are looking at, I'm still holding Microsoft, I'm still holding Adobe, Netflix. Sold obviously Meta too quickly last week. There's been a bit of a pullback, but we have had a pullback up again, it looks like, at the moment. So no major news on my portfolio news. I was looking at buying into Uber again. I really like Uber's company and their numbers. I think it's going to be a huge company going forward. Could have maybe bought it at 72.50 today, but again, it is what it is. So no major news for the start of this week. No adding to my portfolio. I may well add more on Microsoft, or I might even buy at Uber. These are the companies I'm looking for. S&P Global absolutely gone up. I mean, I bought it last week at 401, sold again too quickly. Made some money on it, but sold too quickly. So it is what it is. US 30s down minimally. Very flat market, maybe digesting a little bit of what happened last week. And of course, the earnings season's coming up this week. So that's it, guys. Hope you enjoyed my latest analysis. Please let me know again if you agree or not, or any other topics you want me to discuss, or any companies that you'd like me to look at. Like I said, thoroughly enjoyed my search on Palantir. From one retail investor to another, this is Trader 72. I will be back again this week with another analysis with another company, to be decided yet. but it's hopefully going to be an interesting market. It is very hot here in the UK. It's warming up nicely, and it's going to be another hot week. So let's hope that the markets are as hot. Good luck, guys. Good luck. See you next time.